7. Good afternoon, everybody. This is Jim Kenny speaking to you, and this is for the OptionProfessor.com weekly market update for June the 7th, and that's 2019. As I say each and every meeting here, that past performance is not necessarily indicative of future results, and that short-term trading and option trading does involve substantial risk of loss and is not right for everybody. So do check with your investment consultants and your broker and your clearing firm and your good common sense before you consider any type of trading in your account. Now, I am going to do a share screen here for you so that you guys can see what I'm seeing. I can show you some different things here today. Quick background on myself. If you're new to the broadcast, I have been in the markets here for decades, and I've done seminars on options, learning about the uses and risks of options for cash flow purposes, like covered call writing, or hedging purposes, like married puts and collars and other tactics. I've been doing those webinars for decades, and basically, as far as the webinar updates here, we do them each and every week. I do invite everyone to let others know about the podcast here. They can get the link by going to OptionProfessor.com. And of course, if you have any questions at all, shoot me an email at optionprofessor@gmail.com, and I'll be able to give you a hand with the questions you might have. All right, let's get right into it here. I'm going to do the share here and get that going. And now we can all see the chart that I'm looking at. All right, listen, we had a big news today. What do we got? By the way, I want to, anybody who missed last week, I was in Europe, in Paris and Italy last week, returned this week, so that's why we didn't have a broadcast last week. I did get an opportunity to go through some of the European, things going on in their economy as I was over there. So it was interesting from that angle to hear what they were doing. Basically, let's go over right now, though. We got tariffs possibly going on in Mexico on Monday. And, of course, the tariffs are going crazy all over the place. And we're worried also about tariffs on German autos. And so I don't know if this shall we say, aggressive use of tariffs is going to come back and haunt us. Today, what do we know? We know the jobs report came out, 75,000, way under what they were looking for. But the earnings, 3.1 increase versus 3.2, I think that's pretty much in line. And then the unemployment rate, 3.6, still at that 49-year low. I mean, I've been in this game a long time. This banging the drum for the Fed to ease and do quantitative easing when we're within an earshot of the all-time high on S&P, when we got a 49-year low on unemployment. I mean, I've never seen anything crazier than that. But I guess if you want to get the Dow to 40,000, if that's your only objective, I guess just print money, make it easy for everybody to borrow money, and see if we can make it there. Right now, we had a big run up today. I don't know how it's going to close. I'm talking to you right before the close. It looks like it is trying to roll over a little bit at the end of the day here. I'm going to get into some other stuff real quick here, though. After this report came out, the dollar got hit, and also yields fell. So we're going to go into a lot of stuff here today, and I'm going to try to jam as much in as I can. Retail sales, factory output, home buying, they've all been kind of weak. PMI numbers globally were kind of weak. But I mean, this banging the drum that we're going to 1% or so on the 10-year, I mean, I don't know. And the Fed's going to hike 3 times before the end of the year, some people are saying. I mean, without a stock market drop of size, I would think that that is not a high probability. Now, I would say this. And again, I'm giving you all my opinions today, all my views, all my observations. Obviously, you have your own and others have theirs as well. But as far as the relationship between the 3-month T-bill and the 10-year Treasury note, that has gone negative. And the last 2 times that happened was in 2000 and 2007. And I don't think the stock market did very well after that. So I don't know if this is a warning flag, but I will tell you this. If we don't get above 2,900, 2,950 by after this meeting we have in June with China and Trump, then I think there could be some risk to the market to the downside. So I think this area we hit today around 28.86, let's put that up right now so you can take a look. Because the enthusiasm for stocks, because the Fed's going to give us all this money, and the enthusiasm for bonds because interest rates are going to collapse, is getting a little high. And we've got earnings that are going to start coming out after this month. And so if they're not doing that great and the numbers start looking not that great, then obviously stocks don't go up for no reason. And so if we can't get the 2900, 2950 done, and the things turn bad as far as earnings, and the discussions with China, then the market could have some very big vulnerabilities in Q3. That would be July, August, and September. Okay, in my view. Now, like I say, you see the S&P right there. It's going to have a little problem, I think, at 2,900. If it doesn't, then I think we're going to go after that 3,000 number. But my belief is that it's possible, very well, that this enthusiasm today, which took us to 2884, and now as I speak, it's 2872. Obviously, it's already rolling over to the downside, and that 2886 I thought was a pretty important number. So 2886, 2,900, very tough area to go through, and then of course 2950 or so, the highs, another area. If you can't get through those areas, and we're talking July, August, then I think there could be some vulnerability to stocks. Again, with the inversion of the 3-month and the 10-year, which I'll get into in a second, that could be a sign of things going a little bit awry. There are two sectors or two areas that have been doing quite well. And again, they may have some significant futures, albeit some of them are overbought. Let's take a look at the cloud companies that are involved with the cloud. And I'll give you a few of them right now so you can get an idea of what's kind of hot right now. Adobe Systems. Let's see what they're doing. They were doing pretty good today. They're up 1.34%. But again, they were at 282 and they're now at 278. So next week could be a totally different week than what we're seeing this week. And that's where hedging comes in. I'll get into that in a second. Adobe's there. Next one, TWLO. And of course, that company is Twilio, and you can see, bam, they're going pretty well as well. As you can see, they were at 144. They're right on the high, and they've been doing pretty darn good lately. Look at the 52-week, 53 to 144. So if you want to know where the money seems to be flowing, it's definitely going into this cloud area. NOW, I'm just going to, again, I'm not recommending anything to anyone right here. I'm just showing things that I'm looking at. ServiceNow, another one, up pretty good, 276, now 274. But you can see it's gone from 147 to 281. So that's where the money's been flowing. If you're wondering where money's been flowing, that's definitely one of them. Next one is OKTA. And OKTA today is up about 3%. There you go, all-time highs again, 52-week highs, 41 to 28. That's where the money's been going. And today it went there again. Next one is CRM. That's Salesforce. You probably all know that. And that has gone from 113 to 167 and a little bit to 161. But again, it is a place where people have been throwing their money. There's no doubt about that overall for the last 52 weeks. Let's turn to Amazon. Amazon Web Services, very big for this, guys. And right now, you're looking at a company that's up $50 a share, 2.87. Still well underneath the highs, right? But it's definitely getting a bid here. And again, I think AWB is, AWS is one of the reasons they're getting it. Now, payment processing companies are also doing quite well. Of course, the big names here, Visa. And as you can see, Visa is making 52-week highs here today. So there you go. Let's bring this chart up a little bit. You get some idea of the move, 121 to 171 in the last 52 weeks. And then there's a couple others that you all know about, MasterCard. And MasterCard is currently doing what? It is up almost 4% today. And again, they're breaking out to all-time highs here as well. Or not all-time, maybe all-time highs. I don't have the chart going back, probably. Anyway, definitely 52-week highs here at 266. They've gone from 171 to 266. And then, of course, PayPal. PYPL. And that's another one that is getting on the bicycle here today. And that one's up 2.5%. And it made a 52-week high today. So processing the payments and and the cloud are doing quite well. Now, if the consumer is dead, there wouldn't be any payments to process, right? So you got to figure the consumer is still out there spending money. And so again, where's this big cut in interest rates coming from? It seems like a big scheme, a big scam to me, because again, unemployment's at 3, you're at all-time highs on stocks. People are obviously spending money. Look at the payment clearing companies. And so, I don't know where this interest rates are going to go to zero comes from. I'm not a believer in it. I think if he does that, things like the U.S. dollar could go into a collapse mode. Now, like I say, we don't know what's behind the administration's plans. Okay, if their plan is to get the dollar way down, right, and if their plan is to get lower rates, so they cause some kind of problems with the trade that causes the stock market to have a big drop, and therefore the rates drop. Okay, then that might be part of the plan. Inflation higher. These tariffs are going to be passed on to somebody, so inflation may start kicking up. And then, of course, stocks could temporarily, if they can't get through 2,900, 2,950, they could roll over to the downside in Q3, right? And then, of course, if you call off your tariffs, if the rates are low, and if business starts picking up, it could mean 2020 could be a huge year to the upside. And of course, Mr. Trump does want to get reelected, and it seems like he would, obviously try to put policies in to have everyone happy. Inflation's back. I mean, the farming prices could be up, gold could be up. If the stock market gets running again, if bond investors have made money, but then, of course, their risk would be they'd start losing money if rates go up. But the bottom line is that, if he can get the unemployment to stay steady, if he can get the wages start picking up, the inflation to start picking up, and get the GDP moving a little bit, then obviously 2020 could be a very good year for him to go around and beat his chest about how things are going well. Okay, if that's the plan, then again, dollar going way down, rates going way down, inflation picking up could be the scenario as we go in through the rest of the year. We'll have to see if that happens, and we're going to talk about things that could actually happen if, in fact, that were to happen. Okay. All right. So I gave you some different ones to look at there. Again, we're still seeing utility stocks, have been doing very well. This is the Vanguard ETF, and it just made a 52-week high today. And look, 108 to 135. That's a 30% move on utility stocks, paying pretty decent dividends. So bottom line is that there's a lot of defensive activity out there. If this is such a big roaring bull market, it doesn't seem like they'd be jumping into that. But that's what's happening. All right. Now, like I say, a couple of things I did want to go over with you is, let me just see here real quick here. The banks, because let's see how they're doing. This is XLF, which is the financial sector here, and it's way underneath the 28, and it's certainly underneath the 29. And if it takes out 26, that might not be so good for the banks, which have been touted as fantastic investments for 2 or 3 years, yet they have not delivered much of anything. So the bottom line is, if rates are going to drop and the margins are going to go out the window, then banks could have some trouble. So above 28 on XLF, be interesting, right? And if you break under 26, it could be very well going into the soup. So be careful on the financials. The other ones that seem to be in a little bit of trouble here is the energies. And as you can see, they were doing quite well when they were up at 78, and then they went all the way down to 53, and now they're right around 61. The price of oil recently had a good tank, and that had a little bit of a problem. But we didn't take out this low, which is a positive. And if we can get above 65, that would be interesting to me. And above 70, it could be very well back on the bicycle. But you got to be Missouri on this one. Missouri means the show me state. So show me you can get above 65, show me you can get above 70, and then I'd be much more interested in the energy sector. European banks, I'm going over a lot of different things, but I'm going over things that I'm seeing. Okay. European banks have gotten whacked hard. And one of them is called Deutsche Bank, right? And the stock, basically has been going down, down, down. But, the price to book value, which on stocks like JP Morgan might be closer to 2. Stock like Citigroup could be like 1. This stuff, the banks are between like 20 and 50% book to price to book ratio, which means they're kind of cheap. And I don't know if they're going out of business, but if they are, then obviously you don't want to do anything in this stuff. But when Deutsche Bank, is down at $6 a share or so, the low is 660, and it's right around here. It can't go lower than zero if they go out of business, right? So your risk is $6.76. And there is something that I found interesting here, which is a preferred. Again, that's a instrument you'd have to look into. You'd have to have your advisor or your clearing firm explain further. But essentially, it's a preferred stock. And the one I was looking at here is the Deutsche Bank preferred. Let me get this real quick for you. DKT is the symbol. And again, nothing I talk about today is a direct recommendation. I haven't met all of you. I don't know your circumstances, so certainly I'm not recommending anything to anybody. So bottom line is I'm showing you what I'm looking at here, and then you do your own investigation. But Deutsche Bank preferred is yielding 790. 790. And you can see, these preferreds around par generally are at 25. So it's trading just a little bit above 25, and that's not bad. It did bust under 25 for a little bit here back in December and stuff when things were getting rough. But right now it's right around here, and it's trading 790. If the stock is going to be somewhat stable here between 6 and 7, then there could be an opportunity here, and 790 yield is nothing to sneeze at. So that's something I thought a little interesting. And for you guys out there looking for income, again, they have their own set of risks. They have their own set of features and benefits, and so you need to look into it much more detail than I'm going glossing over it. But clearly, like I say, that's a pretty strong yield. And if you think that the company, while getting all this terrible news, may actually look a little bit better, then of course this might be something to look into. All right, some of the other markets out there. Let's look around and see what else is going on with regards to gold. First of all, I want to show you the dollar, because it is starting to make a move to the downside. If you've been listening to this broadcast, I told you this 98 area was key. You see 98, bam, bam, bam. Okay, a little bit over 98, right? Now it's rolling over, right? And it's at 96.50. Now, if the administration wants to see the dollar tank, it's going to tank, right? If in fact what? We drop interest rates, if our economy starts slowing down because of all these tariffs, the dollar could get in trouble. And obviously the whole world probably owns dollars. So dumping dollars, there's a lot of people to sell, and who's going to buy if there's real reasons to sell? There's not many people. So if you break 95, right, and then of course 94, that opens the door to a much larger decline. And let me show you, if you look back 5 years, what it could look like. This gives you a longer term perspective. There you go. So now you can see it used to be at 80 back in 14, right? And it had a huge rally, right? Well, they take out 95. See this area here? You're going to get some people who want out. And if they all want out at the same time, the guy on the other side, he drops the bid. So, going down towards the 90 area could happen pretty fast under certain circumstances. And going back to 80 is not off the table, or 85, because it was there in 2014. In fact, even 2015, it was at 90. So anyway, it's all according how they're going to work with and fiscal policy. I mean, we're running up the deficit through the roof, and they're talking about infrastructure at $2 trillion. I mean, we're late cycle, and the deficits are going through the roof. That's probably not a good thing. And so the U.S. dollar could very well come under pressure. And if it does, my feeling is that where you might want to have some exposure would be in the gold area. So let's look at the gold shares here and get an idea of what they look like. Certainly not on a lot of people's radar. This is Vector's Gold Miners ETF. Okay, so you can see it's starting to break out to the upside. You see it went down to 20. Now you're breaking up here. You get above 24, and a lot of white area up here, right? A lot of white area. So if it starts getting above 24, that might be a sign that these things are ready to make a move. And if it corresponds with the dollar dropping, it could be something that would be worthwhile to have as part of a portfolio. The other thing you can look at is JDXJ, which are the juniors. And on the juniors, you can see here getting above 35 key. Right now it's about 31. So again, maybe too early, But sometimes you got to keep things on your radar before they get away from you. So the bottom line is this is a sector, the metals and the dollar, which certainly, have not done anything for people to speak of for a while. But that doesn't last forever sometimes. And if the intent is to drop the dollar, drop interest rates, and get inflation coming back, then this stuff could do very well in the months and years to come. So keep an eye on that. And there's your numbers. They speak for themselves. And if you start seeing them to advance, if you wanted to get your exposure going on it, that might not be a terrible thing to look at in that area. Okay. What else did I want to cover with you here today? Yeah. I did want to give you a little bit of an idea on the two things that I look at that have got me thinking that the rally may not break that 2,900 and 2,950. I mean, why would I even think the word bearish on a day like today? Well, it's because the transports and the Russell have been very good to me, giving me an indicator on where we're going. In other words, if we're going up or down. You notice when this thing started to break, we were way over here in what date? Let's see. Okay, transportation average when it started to break here. Well, let me go back to the 1-year graph. Got the 5-year graph up here. I'm going to switch it back to 1. Because you'll notice that when this thing really started to take off on the upside, let's look at the dates and we'll compare it to the S&P. This thing made its turn right around the end of the year, right? And it made its turn down right at the end of April. And it couldn't make any new high in May. And that was when you got a pretty good drop, right? So we've rallied back up a little bit, but there's a stop of resistance right now, possibly, right? And so, this thing turned down at late April, and it turned up in late December. Let's look at the Russell. Now, the Russell has been lagging. The S&P's up 13% plus even more since Wednesday. And so year to date up about 12% or so. The Russell, which I'm going to show you right now, is only up 2 and change. So the Russell and the small caps have totally lagged, as the transports have as well. And I don't think that's bullish. So anyway, here you go. You're up at 1750 on this thing. That's pretty high. Boom, what a drop. And that's in December. Then it came back up. But you see it anywhere near 1750? I don't see it anywhere near 1750. And it took out 1500. Now it's back above 1500. So that's a little bit positive. But it wouldn't take much for this thing to roll back over. The bottom line is this thing is not popping, nor is the transports anywhere near what the S&P is. Let's take a look at the S&P. Okay, you're at a 2873 on the close here, and basically this thing came about 11 points off the high today. So we'll have to see what next week brings. But getting back to the turning point, late April, this thing gave us a turnover in the transports, right? But this thing didn't turn over to May. So 2 weeks after the transports turned over, this thing turned over. And up here, pretty similar. Right in the end, they both turned up about the same time. But the transports gave you a 2-week headway that there was going to be a correction coming. And so you got an ability to catch that. But the bounce back up here to 2,900 is much stronger than you've seen in the transports and the Russell. So again, I'm not a guy who waters on parades, and I don't, badmouth Santa Claus. When things are good, they're good. And we've had a very big rally. But, I'm not in the business of just telling people what they want to hear. So is my view, my opinion, my observation is 2,900 could be a problem. And today's high could be a problem. And 2,950 could be a problem. Those all are in the same neighborhood, basically. And the Russell and the transports are telling me there could be a problem. And the 3-month T-bill inverting with the 10-year Treasury note tells me it could be a problem. So I'm going to say, keep your eyes out. Now, when you think there's a problem, you can sell out some, or you could use the options for hedging. How do you do that? Well, again, I'm not going to give you an exhaustive explanation of it. If you have any questions on it, again, shoot me an email at OptionProfessor@gmail.com, and I'll try to help you with your questions. But again, the concept of married puts is basically where you take a certain amount of money out of your account, and you buy put options, which are basically limited risk rights to sell that have an expiration date, a strike price, and a premium. Right? So Bottom line is if it goes in the tanker, you've got something that would benefit, offsetting what you're taking a risk on with being long stock. Another one is if you think you're at a temporary high point, is sell the out of the money call, take the premium, and buy a put with it. There, you're bracketing, you're giving parameters to your equity. It has an upside ceiling and it has a downside risk. And so bottom line is you have a bracket. You have upside potential, but you got a floor underneath your market, right? So again, if you need more information on that or you have any questions on how they work, again, hedging tactics are very effective when you get turning points. I mean, I'll give you, for instance, that I was trying to tell people a couple of times to look into. I'll give you a few stocks here. Boeing. Boeing went up to, look at that, 440. Well, when it was up at 440, the 200-day moving average was down at 350. Well, when you're $100 above the 200-day moving average and you're a behemoth like Boeing, that's very overbought. Now, I didn't know there was going to be plane crashes and problems with their aircraft, but I do know something happens generally to move it back to the mean. Sometimes, many times. Now, in this case, you could have bought a put up here at 440. You could have bought the 420 put, and then everything under 420 minus the premium would have been hedged. Or you could have sold the call at 460, bought the 420 put with the premium you received on 460. Maybe had little or no cost to do it. And now you got 420 insurance without anything coming out of your pocket from the standpoint of you used the premium of what? The 460 call to pay for it. Another one that I mentioned was Amazon. And I'll give you an example of how that. Now, Amazon's going to have huge premiums, so you almost have to do a collar because you need to bring in premium to pay the other side, because the deductibility of that premium is going to be very, very heavy, and it's also going to put a big dent into your equity. So in this case, you might want to be looking for more of the out of the money call. So when we're up here at 2050, right, first time we tried to make new highs, and notice it hasn't made a new high here, but at any rate, we were down at 1550. 1550 on the 200-day average when we were up at 2050. That's $500 on a huge company. That's way overbought. So you sell a 2100 call, let's say, right? As an example, theoretical example. And then you buy the put, 1900, maybe 1800, whatever. Now you got some floor underneath your equity. Okay? Now if it goes down, that put, 1800, 1900, whatever you got, is protecting your equity, right? So basically, what are we saying here? From time to time, using tactics like married puts and collars are certainly not a bad idea. And if we're not going to get through 2900, 2950, this could be a neighborhood where they could come in handy. Again, the end of the month, we're going to have that meeting, Trump and Xi. That thing doesn't go well, and earnings come out lousy. You're not going to be seeing new highs on the S&P, no matter what the Fed's going to be doing, right? Because again, you have real prices, you have real valuations. They have to be backed by something. Again, sometimes you get a company that's just come line betting, where people are just betting on the future, like Tesla. Unfortunately, if the future starts sobering up and you've bet the whole thing on futures, and people start sobering up and they go, this company may never make a profit or whatever, then you can have a situation where you go from 387 on Tesla down to 204. You see? So, everything looks great when people are, drinking at the party, but when the cops show up and they take the punch bowl away, it can get a little sloppy. So, again, I like to see earnings behind things, because then you've got real profits and real, economic numbers behind the price, not just, I think these guys will do good. Because, I've been in this thing a long time. The whole eyeball deal back in 2000, that didn't work out very well when they turned the lights out in 2001. Coincidentally, when the 3-month and the 10-year inverted. And how about in 2008, when everybody's buying real estate and they're saying what? Houses never go down. I could do no money down. Right? Well, how did that work out? Not so good. And right now, we got companies coming to market that haven't made any money, like Lyft and Uber. And you've got companies like Tesla that have bid up to 400, almost. You're talking about a situation where there's a lot of that froth going on right now at the same time that we got the cross of the 3-month and the 10-year note, which is clearly a warning sign that stocks could have trouble ahead. So I'd be very familiar with how hedging works if I were you, and then I would try to find out when, if ever, it might be effective for me to use. But understand the use, understand the risk, understand the mechanics, understand how you what is your upside potential, what's your downside risk. There's many factors to go over, and that's why I say if you have questions, uh, the easiest thing to do would be to shoot me an email and let myself and yourself discuss how these things work, so that you could actually see if they might be of any use to you, right? So that's optionprofessor@gmail.com. Option, OPTION, professor@gmail.com. All right. We did cover quite a bit of information here today. And again, I did want to invite you to invite other people for next Friday's update. I might even be doing more updates if the market starts rolling over to try to give you up to the minute ways that I think you could protect yourself or participate if, in fact, it cannot get through the 2,900 area. So it could be a very exciting period. And I may do more than one of these podcasts next week or the weeks to come because, again, we could be at a very key turning point, possibly, and in coincidence with the meeting with Xi and Trump. Again, optionprofessor@gmail.com. Send your friends and other associates over there so they can tune in. And again, shoot me the email, optionprofessor@gmail.com, if I can be of any help. Until next Friday, I'm Jim Kenny, wishing you the best weekend and also the best trading you can do. And again, look forward to being with you next Friday. Have a good weekend, everybody. Bye-bye.